Hi, my name is Jessica McCormick, and this is a strategic analysis of Valero Energy. Valero Energy Corporation was established on January 1st, 1980, originally named for the mission San Antonio de Valero, the original name for the Alamo. Valero Energy is among one of the world's largest independent refiners today, headquartered in San Antonio, Texas. Found on their company history page, Valero succeeded the Lavaca Gathering Company, which is owned by the Coastal States Gas Corporation and is a direct result of a $1.6 billion settlement approved by the Texas Railroad Commission in 1978. Valero's natural gas business diversified in the 1980s when the company purchased a 50% interest in a Corpus Christi, Texas refinery owned by Sabre Energy. In the following years, Valero acquired more subsidiaries, and through those subsidiaries, Valero was able to branch into retail and wholesale markets in the US, Canada, UK, and Ireland. In the early 2000s, Valero's expansion was fueled by purchasing a 115,000 barrel per day refinery in Corpus Christi and two refineries on the West Coast, followed by its largest purchase of Ultramar Diamond Shamrock in 2001. With the 2004 purchase of El Paso Corporation's 315,000 barrel per day refinery in Aruba, its international outreach expanded. In 2005, Valero became the largest independent North American refiner after acquiring Primcorp Incorporated and its four refineries. The acquisition of Pembroke Refinery in Wells took place in 2011 by Valero, along with many other marketing and logistics operations throughout the region, as well as another refinery on the outskirts of New Orleans. In December of 2013, Valero Energy Partners was created as a free-based master limited partnership to own, operate, develop, and acquire crude oil and refined products, pipelines, terminals, and other transportation and logistics assets. The acquisition of Pure Biofuels de Peru in the spring of 2018 helped establish a growth platform in Latin America. This transaction included refined product terminals in Callao near Lima, Paisa, and northern Peru. This allowed Valero to lead a supply platform with a variety of different customers in the retail, mining, and airline industries. For the past 39 years, Valero has expanded and grown into the largest independent refiner in the world through acquiring existing companies. Today, Valero has a refining capacity of approximately 3.1 billion barrels per day, which makes it one of the largest independent refiners. Valero is still based in San Antonio, Texas today and is a leading ethanol producer that has the capacity to produce 1.5 billion gallons a year with its 11 ethanol plants. Next, we will go on to Valero Energy's background. Valero Energy is a premier operator within the oil and gas industry. Their primary focus is creating value for stockholders and serving stakeholders. Their sustained profitability within the oil and gas industry requires a good strategy, discipline, and a committed workforce. Valero Energy has been able to achieve this sustainability by demonstrating excellence in several crucial areas. Valero Energy's performance reflects on their continuous commitment to being a premier operator in this industry. In 2018, Valero had several financial achievements and created value for their stockholders and stakeholders. This company was able to return $3.8 billion to stockholders through dividends and achieve $3.12 billion in net income just from Valero Energy Corporation stockholders alone, all while increasing quarterly dividends by 14%, maintaining investment-grade credit ratings, and maintaining a low debt-to-capitalization ratio within the group. In their 2018 financial report on page 2, Quarter attributes the earnings to their logistics investments that they have made over the past 5 years, that their flexibility in the refining system itself allowed them to capture that additional margin. Valero's highest priority is operating safely and reliably and is critical in order to maximize profits. The company has been able to improve its earnings capabilities and realize industry returns by focusing on improvement and excellent performance in crucial areas like safety and operational measures. Valero's mechanical availability has increased from 96.7% in 2014 to 97.2% in 2018, representing a near record performance that is leading the industry, and highly reliable, allowing them to maximize margins, which is a big operational achievement. Other achievements in their operations include the continuous cuts in cost and efforts to increase cumulative savings, as well as achieving the best in their four critical and environmental metrics. Valero had a strong year in 2018 in regards to strategic achievement. The company was able to complete an expansion of their Diamond Green renewable diesel plant to 16,500 barrels per day at 280 million gallons per year of ethanol production capacity by acquiring 3 ethanol plants from Green Renewable Energy and acquiring storage facilities and wells and a fuel distribution in Peru that in turn expanded their international logistic and distribution capabilities. So on to the purpose of this study. The purpose of the study is to perform a detailed strategic analysis of Valero Energy. This is done by first using an external analysis to assess external opportunities and threats, analyze the environment and Valero's competitors in the industry. After the external analysis, an internal analysis will be used to evaluate resources and their capabilities and the core competencies. After the conclusion of both the external and the internal analysis, 2 recommendations will be made to help the firm stay successful and help them continue to expand and grow. Next, we move on to the external analysis of the industry. The external analysis is composed of the general environmental analysis with different subsections that include demographic, economic, political and legal, socioculture, technological, and global segments. Next is the industry analysis, which is composed of the description of the industry, industry dominant economic features, market size, market growth rate, and industry trends. Next is the 5 forces analysis, which analyzes the threat of new entrants, power of suppliers, power of buyers, power of substitutes, and intensity of rivalry. Next is the driving forces analysis, and then the competition analysis, which is composed of the industry competitors, rivals' anticipated strategic moves, and key success factors. So, starting with the general environmental analysis of the oil and gas industry, the purpose of this is to provide an in-depth view of the immediate environment around the firm. Each of these segments are going to be discussed separately in order to determine what the oil and gas industry are challenged with in their immediate environment. With this analysis, firms in the oil and gas industry will be able to face the most crucial and important challenges that are represented while developing their strategies. So up first, this is just a breakdown of the 6 segments of the environmental analysis. So we have demographic, economic, political and legal, socioculture, technological, and global. So starting with the demographic segment, the oil and gas industry has experienced an increase in growth over the past few years with disregards to the economy. When that is combined with the oil and gas industry's aging workforce and those who are expected to retire, there are few professionals that are skilled enough to fulfill the positions of those who are leaving. The World Petroleum Council has made the statement that the industry is on the edge of a demographic cliff, which means that demographics have not gone unnoticed, but recognized as an issue that is difficult to address. From smaller drilling contractors to the larger refinery companies, the issues remain the same across all geographical locations. Continuous expansion in the exploration for developmental activity is international and affects the labor needed everywhere. There is a high demand for young and skilled laborers to fill the vacant positions, and this is why the demographics have such a high impact on the oil and gas industry. Next, we are going to examine and analyze the economic segment. The relationship between the oil and gas industry and the global economy is highly important, and there is no other industry that is so much interdependent with the world economy because of its need for oil and gas to operate. Economic factors that impact the economic segment of the oil and gas industry includes the demand for crude oil and the value of the dollar. The global economy is dependent on the continuous supply of oil and reasonable prices. The international economy is crucial for the development of the oil and gas industry because the demand for energy is driven by economic growth, prosperity, and rising population. A downturn in the economy generally means that the demand for energy decreases, which means a decrease in the demand for crude oil and vice versa for a growing economy. This is because most industries and means of transportation rely on crude oil to operate. Another important economic factor that affects the oil and gas industry is the value of the dollar, which is the currency used in trading oil internationally. For example, when oil prices were soaring in 2008, the value of the dollar was substantially down. This is due to exchange rates. Producers of oil are regularly affected by exchange rates between their national currencies and the US dollar. Therefore, when the value of the US dollar decreases, crude oil market participants usually increase their oil prices, which means oil producers are entitled to a minimum of the same oil prices as before in their own currencies. Because of these exchange rates directly affecting market participants and the dependency on the demand for crude oil in both the oil and gas industry and the global economy, both of these factors contribute to the high impact the economic segment has on this industry. Next, we're going to analyze the legal environment. The legal environment of a business plays an important role in determining the success of any firm. In the oil and gas industry, it's subject to several strict laws and regulations which range from very specific drilling regulations, environmental health and safety laws, and putting specific fields out of commission. Oil and gas are also highly regulated commodities, and companies are required to pay unusually high upfront fees and royalties, as well as taxes. There is also the factor of high uncertainty in regards to the changes in the different laws and regulations, which threatens companies to either stop operations or incur more cost. Major legal concerns, however, affecting these firms stem from compliances with laws and regulations that are concerned with the environment and climate change. Local, state, national, and international laws and regulations are extensive in regards to the products and the operations of firms in this industry. Fuel-specific emission controls and climate change programs will have a significant impact on the scale and profitability of many firms under the extensive amount of environmental laws. Strict legal regulations, environmental health and safety controls, large upfront fees and royalties, and a firm's obligations to abide or be forced to cease operations or higher costs are all factors that contribute to the high impact in the legal segment of the oil and gas industry because of the negative effects it has on a firm's profitability. Next is the political segment. The political environment of a business is crucial to understand if a firm wishes to excel and succeed in its given industry. Political factors that affect an industry include government policy, political stability or instability, foreign trade policies, trades, restrictions, corruption, bureaucracy, and environmental and consumer protection laws. Political factors have a significant influence on the oil and gas industry because countries across the globe are primarily the owners of oil and gas reserves. All of these political factors result in a high impact to the legal environment because of the threats they bring to a firm's sustainability and profitability. Next is the socioculture segment. Socioculture forces determine the values, beliefs, and lifestyles of societies where oil companies operate. These same forces have been shaping society's preferences for different energy types. This trend is forecasted to continue as more environmental friendly energy sources are likely to increase. People have since started to show how concerned about the environment and have put a larger value on healthy living. Since fears of global warming have come forward, social responsibility of societies and governments have increased their focus on alternative energies, which include wind, solar, biofuels, and hydropower. As new and more environmentally friendly energies are developed and the cost to produce them is lower, the environment in which oil and gas companies operate are going to become less favorable. A company's social responsibility is affecting their operations in the oil and gas industry, mainly through their public image. Many now claim that they are actively participating in a role that supports sustainable human development in societies as they operate. Next is the technological segment. The oil and gas industry are heavily technology driven as research and technology play a crucial role in facing the energy needs and challenges of the world. Technology is key from the exploration of oil all the way to the refinement of oil. Technology will have a significant impact on the development of the oil and gas industry in the future especially in the oil and gas industry, long-term sustainability, which makes it a high impact on the industry. Lastly is the global segment. Globalization for several industries refers to the likeliness of supplies, products, and consumers to have access to one another from anywhere in the world. The oil and gas industry is a global powerhouse that employs hundreds of thousands of workers globally and generates hundreds of billions of dollars globally each year. Globalization raises some sustainability issues, particularly those in developing countries. Globalization is a high impact factor in the oil and gas industry. Next, after the environmental analysis, an industry analysis is conducted. It's a description of the industry which will be provided along with the industry's dominant economic features, the market size, the market growth rate, and the industry trends. Every person in the world relies on the oil and gas industry. The year 1858 marked the first drilling of the first oil wells in Ontario, Canada, and then in 1859 the first wells were drilled. Americans know that products produced from petrochemicals are essential to modern life. Dominant economic features include the following. The oil and gas industry itself has economic features and that actually dominate it. The most important include market size, the growth rate, and trends of the industry that it faces throughout the year and those that follow it. The viability of projects in the oil and gas industry rely heavily on economies of scale. So, market size. With the world economy continuing to grow, the oil and gas industry could be moving toward a supply crunch. Few CEOs from Total, Eni, and Saudi Aramco have warned of a supply crunch by the end of the decade. With the demand for oil growing and investment in new projects decreasing, there is the chance that less supply is available. This means oil companies are forced to increase the production or they will not be able to keep up. Industry trends. So the oil and gas industry is a sensitive one, which means the result of one thing causes a different result for another. One industry trend for 2019 is oil supply. Another important industry trend is the energy outlook and energy policy. This refers to a report on the future of energy that incorporates projections on the demand and supply and energy policies for the future on a national and international scale. Oil price and demand is a leading industry trend. Next, we are going to discuss the five forces analysis. The five forces analysis allows businesses to evaluate their industry trends, its attractiveness, the competition, and how to strategically predict what future changes they face and how to position themselves for success. These five forces include the bargaining power of buyers, bargaining power of suppliers, threat of new entrants, threat of substitutes, and rivalry among competitors. Okay, so the threat of new entrants into the oil and gas industry is weak because new entrants find it challenging to establish business in the oil and gas industry. Bargaining power of suppliers in the oil and gas industry are moderate. There are fully integrated suppliers in the oil and gas industry which are active in the entire process of the oil and gas industry. And then due to the global oil benchmarks, buyers cannot affect the price of oil. The only bargaining power that buyers have in the industry is the quality of oil they will purchase. Because of this, the bargaining power of buyers is weak. Threats of substitutes is also a weak force. Alternative sources can replace oil and gas. However, it takes a lot of spending in research and development to do so, and consumers are not so quick to move from gasoline to another source of energy. And then as far as intensity of rivalry goes, it's actually pretty high. Competition in the oil and gas industry is tough and very intense. High rivalry among existing competitors can limit the industry's profitability depending on the competition intensity and basis. So that's why it's a high force. So next we're going to move on to the driving forces. So globalization, technology, and sustainability are a high impact force, and that leaves cost and efficiency a low impact force. So, globalization is a high impact force because it raises some sustainability issues, particularly those in countries. Globalization creates conflicts in the area of jobs because countries constantly compete for development and jobs. Economies without energy can be expected to collapse. A growing supply of energy products is extremely important in terms of keeping the world economy working, which leads us to the next driving force, which is technology. Technological advancements in the oil and gas industry is what is going to keep firms successful and will ultimately shape the future of oil and gas. The goal is to make sure that design, analysis, and equipment, along with the correct implementation, all fall into line. By combining integration and intelligence, it gives the solid footing needed to keep the industry running for decades to come. One of these technological advances is set to transfer oil and gas industry is blockchain, which can potentially decrease the risk of fraud, error, and invalid transactions in energy trading. This will also increase the efficiency of the industry and technology. Um, and then with the third driving force, cost and efficiency, it's critical in any industry, especially the oil and gas industry, but compared to the other driving forces, its impact is relatively low. Generating revenue is an important influence as well as keeping operating costs as low as possible in order to make a decent profit. The revenue that is generated in the industry is high, but the industry still needs to adapt to the global market. Because of increasing demand and dependence on natural gas and oil, it is hoped that this industry will continue to create revenue to invest in new exploration projects and technologies. This means that although costs may be higher up front, over the long run they will decrease as new drilling and extraction technologies are found. This finally brings us to the fourth driving force, which is sustainability. The oil and gas industry must implement a sustainability strategy that drives benefits in the forms of increased revenue and reduced cost. Sustainability is a high impact factor because it is necessary for the industry to reach a sustainable development in the wake of wanting newer, cleaner, and more environmentally friendly energy sources. Sustainability helps mitigate risk and identify opportunities to build a business case, design programs, measure impacts, and report progress to internal and external stakeholders. The oil and gas industry improving their sustainability allows them to improve their impact on the environment, economy, and society as a whole. Understanding these four forces in the oil and gas industry is important for a firm to efficiently and successfully create strategies that will help it to maintain relevance in the marketplace. Next is a competition analysis. Here in this figure, each major competitor in the oil and gas industry is compared to each other by using the strategic group model. This model allows us to compare the largest competitors and the topics of price over quality as well as the degree of vertical integration. So, as you can see at the top of vertical integration are companies like Chevron, Texaco, ExxonMobil, Royal Dutch, and Shell Group. And at the bottom of the vertical integration, companies like Seneco are found, and closer towards the middle is Valero. As far as high price quality goes, international upstream companies such as Apache and Duna Petroleum and Premier Oil are found. Once again, low price quality is found within Nippon, Valero, and Seneco companies. By utilizing this, we can now decide how firms can move forward in the market. Next, we are going to discuss the key success factors in the oil and gas industry. So, these are located in this figure right here, and they include achieving and maintaining economies of scale, increasing global distribution capabilities, supply chain management capabilities, product innovation, technology innovation, and lowering production cost. These factors, when combined carefully and strategically, allows a firm to operate effectively and efficiently. The first factor listed in, shown on the screen is economies of scale. By vertically integrating and establishing more drilling sites, refineries, storage facilities, and advancing technology, a firm can reduce costs. The next key success factor comes from a firm's global distribution capabilities, or getting product from point A to point B in order to maximize profits globally. The third success factor is supply chain management, followed by product innovation. Product innovation is key because a firm in the oil and gas industry needs to uphold their social responsibility and appeal to their consumers. This is done by making products more environmentally friendly and more efficient. Product innovation is made possible by the key success factor is lower production cost. By cutting production cost, more funds become available to use in other aspects of the firm's operations, such as research and development and innovating their product and technology to become more eco-friendly and efficient. Now that the external analysis is complete, we are going to move on to the internal analysis, where it is broken into a few different sections. The first one including the organizational analysis, which covers the corporate mission, products, and services, leadership team of the organization, organizational culture, structure, and strategy of Valero Energy itself. And then we will analyze Valero Energy's resources, such as their tangible and intangible assets, capabilities, core competencies, and sustainable advantages. We will then complete a financial analysis that covers valuation, growth, profitability, financial strength, and management efficiency. Lastly, before making two recommendations, a SWOT analysis will be conducted analyzing Valero's internal strengths and weaknesses and its external opportunities and threats. Starting with the organizational analysis, we use the 7S framework, and this is just a graphic of Hilton McKinney's 7S model. So here you see Valero Energy's corporate mission. Basically, Valero Energy's corporate mission can be understood by evaluating the firm's mission statement that expresses their guiding principles in achieving excellence in their business, industry, and the relationship that is provided above. Valero Energy's identity is investing in excellence, which is their business and their employees. So, for their products and services, Valero Energy operates in three main segments in the oil and gas industry. These three segments include refining ethanol and renewable diesel. Within these segments, the firm manufactures and markets fuels, producing 4 primary fuels and 8 specialty products. As a vehicle for progress, Valero Energy produces cleaner burning gasoline, diesel, ethanol, blended fuels, and much more. And then on to the leadership team. So, as chairman, president, and CEO of Valero Energy, Joe Gorder's responsibilities to include leading his company and his board of directors into success in the oil and gas industry. His time with Valero as chairman, president, and CEO has been long but rewarding. Mr. Gorder serves alongside 17 executive members, each serving multiple roles and fulfilling several responsibilities across the company's operations. Next, we have the organizational culture. Valero is committed to health and safety, sharing their success with communities, employees, and stakeholders, and with society as a whole. The primary culture qualities within Valero Energy are social responsibility, sense of unity, and its core values: integrity, achieving excellence, and reliability. So Valero Energy competes on totally wrong thing. So with both of these culture aspects, Valero is able to achieve excellence with its employees, communities, and stakeholders. The most important aspect that Valero Energy follows is its relationship with its employees, communities, and stakeholders, and society as a whole. Social responsibility is another key aspect in the culture of the firm. Everything the firm strives to do is in the best interest of communities, employees, and stakeholders because without them, they would not be the company that they are. The company core values of integrity and achieving this excellence create the framework that builds their mission statement. By using these core values, Valero can create its business model, which allows it to survive in the harsh oil and gas industry. Next, we are going to go on to Valero's structure. Valero's organizational structure is formal and informal framework of policies and roles within which an organization arranges its line of authorities and communications and allocates rights and duties through an executive team, board of directors, shareholders, and regional offices. The higher levels consist of an executive team and board of directors who focus on being more effective, while the lower regional offices are focused and tasked with being more on the efficient side with available resources. Valero Energy strategy operates under a cost leadership strategy driven by efficiency, size, growing scale, and experience. Like many other firms, each subsidiary and business segment operates on a low-cost focused strategy because of the specialization in one market while competing with cost. Valero Energy competes on a global scale, offering a wide variety of goods and services for its refining, ethanol, and marketing operations, including the areas of strategic sourcing, refineries, ethanol plants, transportation, and natural gas, similar to those of its main competitors, Shell, Exxon, Royal Dutch, etc. Valero continues to focus on safety results for employees and contractors as well as lead with the highest safety designation by the U.S. Occupational Safety and Health Administration and other agencies. Their biggest focus is reducing air emissions resulting from operational events such as startup, shutdowns, and malfunctioning events. Operational excellence is also a key focus in driving their profitability as a company and in turn improves their environmental performance. So next we are going to go into a resource analysis. This is just the VRIO analysis of Valero, which stands for valuable, rare, difficulty to imitate, and different resources that the organization is organized around. So this is Valero Energy's VRIO analysis. So starting with tangible resources. So tangible resources are physical items including inventory, machinery, cash, land, or buildings, and can be easily liquidated. Valero Energy's tangible resources include refineries, retail locations, equipment used to extract, refine, and transport their products, storage facilities, financial assets, and technology it develops. While each of these resources are valuable to Valero Energy, only its financial resources are to be considered rare because strong financial resources are only possessed by a few companies in the industry and aid in investing into external opportunities that come forward. Valero Energy's intangible resources lack physical substance. So this is their intangible resources. Intangible resources lack physical substance and are usually very hard to evaluate, and they provide value to the company in the future. So these can include human assets, patents, copyrights, franchises, and even brand image. So the firm's resources itself are employees, patents, and their distribution network. Although all of them are valuable, employees of Valero, the company's patents, and its distribution network are considered rare. Employees of Valero are considered rare because they are highly skilled and trained compared to other firms in the oil and gas industry, and there's a better work environment and compensation packages to ensure that these employees stay. Patents of Valero are also rare resources because they are not easily accessible and not possessed by any of the competitors, which means Valero can use them without interference from its competitors. And then the firm's distribution network is also rare because most competitors require a lot of investment to design and achieve a better distribution network than that of Valero's, and they're possessed by very few in the industry. So, capabilities. This is just a firm's ability to manage resources effectively to gain an advantage over their competitors. The capabilities of Valero is its ability to refine crude oils that they can buy cheaper than Brent crude, which is the international benchmark that sets prices for refined products. They can also retain a skilled and competent workforce to drive customer service and excellence and distribute their products on their rare distribution network. Because they can buy this crude oil cheaper, their financial resources are greater and are strategically invested into the right places, which creates opportunities and combats threats. Valero has a skilled and competent workforce that is fueled by one of a kind training programs, a good working environment that is safe and full of benefits and growth opportunities, as well as compensation packages. Their distribution network is costly, which makes it hard to imitate. Is very well organized and is used to reach customers and ensure that products are available in every outlet. So, next we have core competencies and sustainable. And sustainability is, and sustainable advantages. So, core competencies are defined as resources and strategic advantages of a firm, including pooled knowledge and technical capacities that allow a firm to be competitive. Based on the VRIO analysis on Valero, the core competencies that Valero Energy is organized around and provide it with sustainable advantages have been identified as financial resources and their distribution network. So their financial resources is tangible and its distribution network is a capability, and both are key to compete in this industry. These focus on providing for the customer and Valero Energy as a company, and it also ensures that the products are on every available outlet to fulfill its mission of investing in excellence. So next we will go over the financial analysis. The financial analysis will include the examination of Valero Energy's valuation, growth, profitability, financial strength, and management efficiency. This allows insight to its current and past performance and allows predictions to be made in the future. So we will first start with the valuation. So the price to earnings ratio represents and compares the share price and share earnings. You can see this in the second row of this chart. This represents the amount of money an investor is willing to spend per share per dollar of current earnings. Based on this table, the ratio is increasing from 2015 to 2017 before declining in 2018 and then increasing again in 2019. Although 2019 is not over yet, the current rate provides evidence that the rate should continue to rise and remain higher than that of 2017. This is not concrete information, though. The price to sales ratio compares the stock price and its revenue. The higher the ratio is, the more investors are willing to pay per share for every dollar. Between 2015 and 2019, the ratio has increased, and then in 2019 has decreased. It only provides one view into the firm's financial situation, and 2019 is not over yet. The price-book ratio is a comparison between the market value of stock versus its book value. The firm's stock is valued and the firm is financially stable. PB ratios above 1 represent financial security and no expected declines in earning power, which is the case for Valero Energy. Next, we'll go to the growth analysis where revenue, operating income, net income, and earnings per share is evaluated. So, revenue growth represents the growth in revenue from one year to the next. A firm that is sound and is in an established industry should be seeing increases in revenue in steady increments. Operating income growth represents the growth of a business earnings before interest of taxes and is calculated by subtracting operating expenses from revenue. Valero Energy's operating income has changed quite drastically from 2016 to 2019. Lack of growth can be concerning because investors are not likely to invest if they cannot make money and if the firm cannot maintain growth. Net income growth represents revenues minus cost. Profits are used to increase business growth and pay out to shareholders. And then earnings per share is a portion of a company's profit allocated to each share of common stock. While EPS increased by 85.43%, in 2017 it declined by 20.41% in 2018 and has already declined by another 31.66% for the first half of 2019. The lack of profitability is concerning and could be a result of an industry-wide hardship. Next, we move on to the profitability analysis. So, gross profit margin is calculated by dividing gross profits by revenues. It is used to measure profit after subtracting cost of goods sold, allowing the calculation of profitability to be done. Gross profit represents how well a firm performs and its ability to cover its expenses. Valero Energy's gross profit remains relatively constant with a dip in 2018, but then increases again. Operating profit margin is an analysis of a firm's ability to operate efficiently and their pricing strategy. Valero Energy's efficient and strategy has not been successful with operating profit margin. Net profit margin ratio compares profits and revenues and allows an insight to see how much profit is generated for every dollar of revenue that is received. There was a decline in 2016 and did not increase again until 2018, and when it did, it was just barely before declining again in 2019. This decline is a concern for investors and can be alarming because market conditions are unfavorable and recovery can be difficult. Next is the financial strength analysis. So basically, we're going to analyze the current, quick, and debt-to-equity ratios. So the current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations or those due within 1 year. The firm can increase its liquidity and is unable to pay short-term and long-term debts, it will run into financial issues. So because Valero Energy's current ratio is over 1, it means that the firm's liabilities are less than its assets, and if obligations become due, it would be able to pay them off. So all of them are above 1 between 2015 and 2018. And then the quick ratio indicates a firm's short-term liability position and the measure that firm's ability to meet its short-term obligations with its most liquid assets. So, for example, a result of 1 is considered to be a normal quick ratio and suggests that a firm has enough assets to liquidate if needed. So as of 2018, since 2019 isn't current yet, Valero Energy has a quick ratio of 1.09, which means the company has $1.09 of liquid assets available to cover $1 of its current liabilities. So the debt to equity ratio measures a firm's financial leverage and is calculated by dividing total liabilities by shareholders' equity. The debt ratio provides data on how much debt the firm has to its assets computed to shareholders' equity. So Valero's debt to equity ratio remains relatively constant. There's a small change between 2016 and 2017, and then again 2017 and 2018. And then next we have the management efficiency analysis, which is the return on assets and the return on equity. So the return on assets ratio compares profitability of a firm to its total assets and measures how efficient the management is at using its assets to generate earnings. Valero Energy's return on assets is well above the recommended 1, showing the firm's ability to efficiently generate earnings. The return on equity ratio, as seen in Figure 21, is calculated by dividing net income by shareholder equity. This compares the firm's profit it generates to using money invested by its shareholders. Valero Energy's return on equity remains positive and continues to grow. So, therefore, Valero Energy is actually in a good financial position. So, next, before our external and internal recommendation is made, we need to complete a SWOT analysis. So, the SWOT analysis is used to evaluate a firm's internal strengths and weaknesses and market opportunities and external threats. The following sections will discuss each of these, including Valero's internal strengths, followed by internal weakness, external opportunities, and lastly, any external threats Valero faces. So, we are going to start with strengths. So, customer satisfaction and investing in excellence with a strong dealer community has always been one of the greatest strengths of Valero Energy. Valero has built a strong culture among distributors and dealers where they not only promote Valero's products but also invest in training, which brings a high level of customer satisfaction because they are dedicated to customer relationships. This is done by managing present customers and creating good brand equity to potential customers. Strong free cash flow is another strength that Valero has always possessed. These high, strong free cash flows help provide resources to the company and allow it to expand into new products and services. Automation of activities has brought Valero Energy products the consistency and quality needed to scale up or scale down based on the demand conditions in the oil and gas industry. Next, we are going to analyze the internal weaknesses. So, product range brings the risk of allowing competitors a foothold in the market, which is something Valero has struggled with. There are too many gaps in the product range sold by the firm. Forecasting has been another weakness for Valero Energy. The firm itself is not very good at demand forecasting, and it leads to a higher rate of missed opportunities when compared to its competition. This results in keeping a high inventory both in the channel and in-house. Compared to competitors in the industry, Valero has a high attrition rate in the workforce and has to spend a lot more on training and developing employees compared to its competition. The last weakness is Valero having a very high days inventory, which makes the company raise more capital to invest into the channel compared to its competition. This in the long term can impact the growth of Valero Energy. Next is going to be the external opportunities. Valero Energy's first external opportunity would be market development. Market development will lead to the decline of a competitor's advantage and will allow Valero to increase its competitiveness compared to its competition. Economic uptick also stands as an external opportunity. With economic growth and an increase in customer spending after years of recession and a slow growth rate in the oil and gas industry, Valero Energy can gain new customers and increase its market share. New technology also provides Valero with the opportunity to differentiate through pricing strategy in the new market and will enable them to maintain its customer loyalty with its great service and attract new customers through value-oriented propositions. Stable free cash flows will also provides Valero with the opportunity to invest in different product segments that are adjacent to its existing ones. With more cash, Valero Energy can invest in new technology as well as these new product segments. This opens a window in other product categories. External threats for Valero. So an external threat that is faced is a shortage of skilled workforce in certain global markets and represents a threat to steady growth and profits for Valero in those markets. Currency fluctuations are another threat because they are operating in a number of countries that are exposed to these fluctuations, especially given the volatile political climate in a number of markets globally. New technology that is developed by competitors or a market disruptor is a serious threat to the industry and Valero Energy long term. Rising pay levels, especially movements such as a $15 an hour and increasing prices in China, lead to pressure on profitability for Valero. So, next we're going to move on to our recommendations. So, we have our external recommendation, which is the technological change and environmentally friendly alternatives is one of the most significant driving forces in the oil and gas industry, focusing on operating efficiency and cleaner alternative energy sources. Environmental expectations will continue to be placed on firms operating in this industry who have not already invested in these innovations, especially cleaner alternatives. The firms who have succeeded to meet these expectations and continue to evolve their technology will have no issues when new laws and regulations are enacted. Firms who want to be successful in the future that is to come must welcome this technology change and environmentally friendly alternatives. Lastly is our internal recommendation. So, Valero Energy must focus on maintaining their strong free cash flow to make investments, developing new technologies to stay competitive, and work on their demand forecasting and product range. By doing this, Valero Energy gains a competitive advantage over its competition. And then attached are my references, and that is my strategic analysis of Valero Energy. Thank you.